Okay, good morning, ladies and gentlemen. Now it gets to banking from crypto assets and politics and whatever, so I bet you're all looking forward to some coffee at some stage. How did it all start? I'm going to talk some words that some of you in the audience may not understand, or you may not have heard them, they may not have existed in your lexicon. But back in 1994, we were running Barclays Merchant Services, and that effectively allowed us to collect point-of-sale transactions from people buying and selling things in shops in Jersey. We also put in place a connection to a thing called the internet via Canterbury University, and that allowed us to effectively see what was going to become the World Wide Web using a piece of technology known as Mosaic, which was the early internet browser. And then we took a piece of technology, and I want hands up if anybody knows what this is, called an interfaker. Oh, come on, Mr. British Computer Society, you're going to fail. All right, an interfaker allowed you to see the signal from one device and put it into another device and work out how to get the comms working. It always comes down to the piece of cable and the connection. And what that did was that allowed us to build the world's first online shop in 1994, which is where e-commerce came from. So that's where it all started from. A few years ago, I was talking to the UK regulators. I went along, as you know, I founded WorldPay, which is a massive company still today. And I was talking to the UK regulators about market change. And in the UK, we had 4 main clearing banks. Most of you live here will know who they are. And they, over the course of many years, had consolidated together. That had reduced competition. Now, if you're a journalist, you turn around and say, well, this is all part of a great plan to create a cartel. The reality is that very rarely happens because you've got to be very clever to build a cartel. It was just a consequence of change, a consequence of market opportunity. But what had happened was that by creating these large monolithic banks, competition change and transparency was disappearing from our financial services. And the ability for smaller financial services organizations to compete and to wrest customers from some of the larger banks became very, very difficult. And I know you've got Anthony Jenkins in here later on. You've got some questions now for the Q&A for him. So I basically posed a challenge to the Bank of England, the PRA and the regulators. And I said, why haven't we had a new clearing bank? Because if you create something new, you have the ability to do something completely different. You have a white piece of paper. You have no customers. You have no legacy. You have no liability. You have a vast amount of opportunity. You can change the way things work. You can change the way that money is managed. You can change the way that you actually interact with your customers. And you can de-risk processes which historically have been and remain today quite risky, because we can all remember the global financial crisis. So what we did was we built a cloud-native bank with Microsoft using microservices. And this isn't going to be a technical presentation. Basically, moving a bank, bricks and mortars bank, up into the cloud and saying, we're going to run this bank completely differently. We're going to link in, we're going to become a proper bank, prudentially regulated, exactly the same as the big 4 banks, linked in to all of the main payment systems in the UK. And we're going to process those in real time. And we're going to be a really different bank. We're going to be the only bank in the world that's a commercial bank that offers to be in a position to pay all of its customers' money back on demand. And so Mark Carney said, Nick, that doesn't quite make you a bank, but it makes you a safe bank for the market. So we put this bank up, and we started developing and bringing customers on. And we employ 300 people in London today. Half of those are technologists. All of the systems that we have, we built. We didn't buy any core tech. And the reason for that was as soon as you buy technology, you inherit a legacy. And the legacy is what's been holding the market back, which I'm going to get onto in a second. We realized as a consequence of the tech stack that we'd created that we could clone ClearBank and create another bank in Europe. And so we're bringing another bank up that's identical. And this gets a bit technical for you. We effectively have UK customers, Euro customers, dollar customers, and whatever. But one of the things we do is we see something called liquidity. And liquidity is the way that you are allowed to make payments by your bank. Have you got any money? Are you allowed to make a payment? And everything comes back to something that's simple. And liquidity is the power and the knowledge that drives the global financial systems. So we realized that actually by having a UK bank and a European bank, we could see real-time liquidity across two central banks. And so we could do payments for our customers in milliseconds. Now, for some reason today, they take 3 days. Now, I'm certain that's to do with somebody getting on a train, going on Eurostar, and taking the physical cash to somebody in Europe to deliver the money, which, believe it or not, is not now required. We've moved on from that. So we looked at that, and then we thought, actually, hang on a minute, there's a way to change this. And we had, I think everybody who was an innovator will have the however moment, or the what if, or the oh shit moment. They all come along together. And so what we've just basically put together is the world's first real-time gross settlement liquidity network. Because believe it or not, banks don't know whether other banks have got any money. And this has been going on for a while. In 1970, many of you will have heard of an organization called SWIFT. There was a great idea, let's get rid of telex machines, and this might again be something that you've never seen. Telex was rolls of paper with little holes in. It was very clever, it sent messages very slowly and very expensively between counterparty banks. The idea was to create SWIFT, which was an interbank messaging system, which would get rid of the paper rolls. So SWIFT was being built, Herstatt Bank failed, because of the lack of time zones between different banks, German bank in this case, and US banks. And what that failure led to was the creation of the Basel Committee for Banking Standards and the Bank of International Settlement. Even with all of that, we still had the global financial crisis in 2007 and onwards, which ramifications still rattle on today, which was about lack of visibility to liquidity, the money in your pocket, the dollar bills in your pocket. And there's a bit of an interesting thing that I learned at the Federal Reserve Bank, that different central bankers viewed liquidity in a different way. For those of us in the UK, we know that on our banknotes, we have saying, I promise to pay the bearer on demand, signed by our chief cashier. In America, they just have in God we trust. Anyway, each to their own. Around the world, real-time gross settlement systems are transforming domestic payments. We have faster payments here. They have a massively clever fast system running in Australia. But they're not interconnected. The central banks don't talk to each other. All of the cross-border payments and technology, the ability for us to improve by $2.5 trillion a year, the liquidity of our economy is locked in legacy architecture. All right? Why? Because people don't communicate. Perhaps we need to go and buy 200 interfakers for the 200 central banks around the world and plug them all in so they can talk. All right? And although there have been changes in messaging, all right, changes in technology, blockchain, whole raft of various other things, there has never been the ability to actually look in real time at liquidity because it's invisible. Because what I have in my bank, Mark Carney might know about tonight, but the Federal Reserve Bank in the USA will never know. So what we've done is we've changed the way that liquidity is managed. What we've done is gone from a simple transaction which occurs today, somebody going to a UK bank wanting to buy US dollars and send them to North America. We actually lock the liquidity of the UK bank so we know we have sterling. We lock the liquidity of the US bank so that we have dollars. And when the customer says they want to buy, we release both locks. It's very complicated, but that's innovation. Sometimes it's really the simple things that can create a global change. And what we're now doing is rolling this technology out around the world via central banks and through correspondent banks. And you hopefully will see some of this appearing during the early part of 2020. And one of the benefits of this is we're using a messaging format called ISO 222, which some of you may know. It allows us to attach deep data onto historic messaging. And so the amount of information that we can attach to messages which flow through the global financial system, affecting monetary policy, which affects interest rates, our ability domestically to get mortgages and loans, everything that everybody does in this room is improved by our access to liquidity and our access to data and information. If you're innovating, you need to go and get some patents. That's the whole purpose of this slide. Protect your investment, protect your ideas. One of the things that we found about building our business and developing where we're going to go to is it has to be good fun. All right? I don't know how many of you in here work for innovation businesses, are innovators, looking to set up new businesses, or work for large organizations. But one of the benefits that I've had over the course of the last few years, going through and building the businesses that I've been fortunate to create, is that it's incredibly good fun. And there are many, many opportunities for change that exist around the world today, which can be exploited by many of the people in this room. Just remember, the interfaker is the ability to look at something in a different way and reconnect the components in a different way to create a transformation of a market opportunity, which gives substantial benefits. So I'm a little quicker than the other one, so I apologize for that, but bankers you always want to get rid of. My prediction, because I was told, I think a couple of days ago, come up with a prediction for the future. My prediction is quite profound. No bank in the world gives its customers a service level agreement. It doesn't exist. You don't get it. If you go to your bank today and you say, can you do something for me? They'll say, yes. Great. You'll say, when? And they'll say, soon. And you'll say, when soon? And they'll say, sometime soon. Don't worry. Trust us. And you walk out of the door or you end your session, and that's what you do. And the reason why banks don't have service levels, all right, is because the industry that they're in and the legacy architecture that they are on, they cannot re-engineer quickly enough to get a consolidated service level which benefits all of us as consumers of financial services. So my prediction, brave or not, is that two things are going to happen. Banks are going to move to a position of being able to give customer service levels because over the course of the next few years, they're going to be able to share and see the intrabank liquidity that they've got, which means that when you want to make a payment from Australia to the UK, from a business in Australia to a business in Hull in the UK, you will know that 8 seconds after you've said pay, that business in Hull will have the money. And that's not rocket science. That's exactly what would happen if you'd got on a plane, you'd flown to Heathrow, you'd driven up to Hull, and you'd handed a bag of money over. So you're going to see some massive changes in financial services, and the net beneficiaries of all of that are hopefully everybody in this room. Thank you.